The year is 1706, and inside the smoky confines of Edward Lloyd's coffee house in London, ship captains and merchants are making deals that will change the world. They're not trading spices or silk, they're trading something far more abstract, the value of human life. A widow whose husband might drown at sea could receive enough money to survive. An orphan whose father might perish in a warehouse fire could avoid destitution. Life insurance was born from compassion, from the recognition that death leaves behind not just grief, but financial ruin. It was a product designed for protection, for security, for peace of mind. Fast forward 3 centuries, and that same financial instrument, created to protect the vulnerable, has become one of the most sophisticated tax avoidance mechanisms available exclusively to the ultra-wealthy. A financial product created to protect widows and orphans is now one of the largest, most secretive tax loopholes for the ultra-rich. The question isn't whether this transformation happened. It's how a tool meant to safeguard families became a legal pathway for billionaires to shield millions from taxation. The early life insurance market was remarkably straightforward. You paid premiums throughout your life, and if you died, your beneficiaries received a payout that could cover funeral expenses, pay off debts, and provide income replacement. The moral calculus was simple. Society benefits when families don't fall into poverty after losing a breadwinner. Governments recognized this social good and provided tax advantages to encourage participation. In the United States, the Internal Revenue Code granted life insurance death benefits tax-free status, a provision that remains embedded in tax law today. The reasoning seemed unassailable. Why would you tax money meant to replace lost income and keep families afloat? For decades, this system worked largely as intended. Middle-class families bought policies from companies with names that sounded like institutions of civic virtue: Prudential, Mutual of Omaha, New York Life. Insurance agents were pillars of their communities, selling security door to door, sitting at kitchen tables, helping families calculate how much coverage they needed to protect against the unthinkable. But the financial industry possesses a peculiar talent for identifying tax advantages and exploiting them far beyond their originally intended purpose. By the mid-20th century, insurance companies began adding cash value components to their policies. Whole life insurance allowed policyholders to build savings within their policies, and that cash value grew tax-deferred. Still, for most Americans, these were modest savings vehicles with relatively low returns, conservative investments that would never make anyone wealthy, but provided a forced savings mechanism. The real innovation, the one that would fundamentally transform life insurance into a tool for the wealthy, came later and required a more sophisticated understanding of tax law and regulatory loopholes. The key insight was elegantly simple, yet profound. If investments inside a life insurance policy grow tax-free, and if there's no meaningful limit to how much can be invested, then life insurance isn't really insurance anymore. It becomes a tax shelter with a death benefit attached. Enter private placement life insurance, known in wealth management circles as PPLI. These policies, available only to individuals with millions to invest, function fundamentally differently than anything sold to ordinary consumers. Instead of the insurance company choosing how premiums are invested, the policyholder directs where premiums go, often into hedge funds, private equity, or other alternative investments that would normally generate substantial taxable income. The mechanics of PPLI reveal the elegant brutality of the strategy. Imagine you're a billionaire with $10 million generating significant capital gains and dividend income each year. Under normal circumstances, you'd pay capital gains taxes when you sell appreciated assets, taxes on dividends as they're received, and taxes on interest income. These taxes can consume a substantial portion of your returns, particularly in high-tax states where combined rates can exceed 40%. But if you transfer those assets into a PPLI policy, several transformative things happen simultaneously. The investments continue to grow, potentially at the same rate or even higher than before. But now that growth occurs entirely inside the tax-advantaged wrapper of life insurance. No capital gains taxes when assets are sold and repositioned within the policy. No taxes on dividends regardless of how much income the investments generate. No taxes on interest or any other form of return. The accumulation happens entirely tax-free, compounding year after year without the drag of taxation. When you need money for living expenses or purchases, you don't withdraw it directly from the policy, which might trigger taxation. Instead, you borrow against the policy's cash value. These loans aren't considered taxable income under current tax law because you're technically borrowing against an asset you own. You're essentially accessing your own money without ever triggering a taxable event. The policy's investments continue growing, hopefully at a rate that exceeds the interest charged on the loans. And here's the final piece. When you die, the death benefit pays off all outstanding loans, and your your heirs receive the remainder completely tax-free. The investments were never taxed during accumulation. The money you accessed through loans was never taxed, and the final distribution to your heirs is never taxed. Across your entire lifetime and beyond, those millions completely escape taxation. The numbers involved are staggering. A typical PPLI policy for an ultra-wealthy individual might have a death benefit of $15 million, the nominal insurance amount required to maintain the policy's tax status, but hold $50 million or more in cash value, representing the actual invested assets. The insurance component, that original humanitarian purpose of protecting dependents, becomes almost vestigial, a technical requirement maintained solely to preserve the tax treatment. The policy is insurance in name only, functioning as a private investment account with extraordinary tax benefits. The IRS has established rules ostensibly meant to prevent exactly this kind of tax avoidance. Investor control provisions aim to ensure policyholders can't have too much direct control over specific investments, and diversification requirements demand that assets remain reasonably spread across different investments. But wealth managers and tax attorneys have become extraordinarily skilled at structuring PPLI to satisfy the precise letter of these regulations while utterly abandoning their spirit. They use independent investment advisors as nominal decision makers, create customized insurance-dedicated funds that meet diversification tests while effectively replicating desired investment strategies, and employ other technical maneuvers that render the regulations largely toothless. The offshore dimension adds another layer of opacity. Many PPLI policies are issued by insurers domiciled in jurisdictions like Bermuda or the Cayman Islands. The policyholder remains a U.S. taxpayer subject to reporting requirements, but the insurance company itself operates in a jurisdiction designed to facilitate privacy and minimize scrutiny. This structure adds complexity that makes regulatory oversight difficult. Policy documents remain private and protected by insurance confidentiality laws. Investment strategies stay hidden from public view. The wealthy can invest in opportunities completely unavailable to ordinary investors, all within a structure that eliminates tax liability entirely. What makes this particularly galling is the stark contrast with how ordinary Americans experience taxation. A middle-class worker pays income taxes on every dollar earned through their labor. Capital gains on their modest investment accounts face taxation when realized. Even traditional retirement accounts, like 401k plans and IRAs, have strict annual contribution limits, currently around $22,000 for 401k plans and $7,000 for IRAs. These accounts also require mandatory withdrawal starting at age 73, forcing retirees to take distributions and pay taxes eventually. Meanwhile, there's effectively no limit to how much wealth can be sheltered in PPLI. Some policies hold hundreds of millions in cash value. The Government Accountability Office has estimated that the wealthiest Americans collectively hold tens of billions of dollars in these policies, representing billions in lost annual tax revenue that must be compensated for through higher taxes on everyone else or reduced government services. The philosophical questions become unavoidable. Life insurance tax benefits were created with a specific social purpose: to protect families from financial catastrophe when a breadwinner dies unexpectedly. When that benefit is redirected to allow wealthy individuals to avoid taxes on massive investment portfolios, has the policy outlived its justification? Defenders argue they're simply using legal tools available to anyone. Technically, PPLI is available to anyone who can meet the minimum investment requirements, typically several million dollars. But that defense rings hollow. Saying PPLI is available to anyone is like saying private jets are available to anyone who can afford them. The access is theoretical, but the reality is entirely exclusive. Congress has attempted reform, but intensive lobbying blocks every effort. Life insurance transformed from protecting widows to enriching billionaires, showing how noble tax advantages become wealth preservation tools while ordinary taxpayers compensate for lost revenue.